Traders at UBA expect another bearish session in the bills market as the interbank market becomes tighter after bond auction settlements. Kenneth Onuoha, team member at Assets and Liabilities at UBA, joins me now for more midweek market updates. Thank you so much for your time today, Kenneth. It's midweek here. We've seen the bond auction and the settlement already play out so far. Let's get your wrap of the week so far in that market, the fixed income and the FX space.
All right, thank you so much for having me. Good afternoon, Kenneth. We'll start off with the bond auction. That was basically the highlight for the week so far. Like you rightly pointed out, 450 billion was up on offer across three maturities, were 2029, 2031, and 2033, respectively. Now, interestingly, the 2033s made its debut at the bond auction in May, replacing the 2034s. And what we did see there was, against the 450 that was put up on offer, we saw total subscription levels hit at about 551 billion. Now, the main theme for what we did notice particularly was the fact that the 2023s did account for at least about 68% of the subscriptions that we saw at the bond auction. So that translated into stop rates generally printing at about 19.29, 19.74, and 19.89 across the three maturities. Now, what's interesting is we saw 1 basis point decrease in the 2029s and 2031s. While, of course, since those were the reopened maturities, where for the new maturity we saw it at 19.89%. Now, the subscription levels that we saw at this auction, interestingly, is the lowest of its kind since the beginning of the year, since at the bond auction. So that's a lot to actually take in. Having said that, very quickly, I'd like to also state that the treasury bill and the bond secondary market on the bond side, we've seen that activities particularly centered around the new auction bonds. And at the end of the day, yesterday, we saw major trading activities pass through the 2031s and 2034s, respectively. On the treasury bill side, of course, system liquidity has really hampered, weighed down on that market. And so we saw more offer against, most offers outweighing the bids and the most part of the curve, except the May bills, which had very scarce offers on display yesterday. That now takes us very quickly to the system liquidity. Now, markets has been in ripple since the beginning of the week. Now, as at Monday, the system opened with a negative balance of 289 billion. This was largely a far cry from where we were at close of start of business on Friday, where it was in a positive position of 81 billion. Now, on Tuesday, we came and we saw that the system opened with a negative balance of 323 billion. Now, this was largely driven by outflows to the NNPC from some banks to the central bank, and so that, of course, depleted the system liquidity as at Tuesday morning. During the course of the day on Tuesday yesterday, we saw CRR activities. There were debits and there were also refunds to some members of bank yesterday. And then we saw some swap maturities as well as remitter inflows. These largely contributed to the opening balance we've seen today at 121 billion long. However, we do expect that post the settlement of the bond auction, where 380 billion will be taken away from the system, we expect that would obviously cause the system liquidity to further shrink back into a depressed level.
Yeah, but any respite in the near term for liquidity?
Sorry?
Any respite in the near term for liquidity as you look down the line? Any maturities or coupon payments coming on board?
At the moment, nothing is expected. Nothing significant is expected. Of course, except the CBN continues to intervene, but as we did see yesterday. But at the moment, no respite is coming in. So we will continue to manage the situation as it is.
Yeah, but very quickly, I'd like to get your reaction to the inflation numbers. A very important data point coming into the market here. MPC is just around the corner. How is the market pricing that in?
All right, so like you rightly pointed out, for the 16th consecutive month, we saw inflation rise to today. It was the figures came out at 33.69. Now, this is about 49 basis points increase from the 33.2 that was observed in the month of March. But if you look at the rate of increase, it is less compared to what we saw between February and March. Between February and March, we saw a 150 basis points increase. Between January and February, we saw a 180 basis points increase. That's from 29.9 to 31.7, from 31.7 to 33.2, and from 33.2 to 3.69. So interestingly, the actions of the central bank are reaping rewards. It may not be in the immediate, it may not be seen in the immediate, but over time we have seen that yes, this is actually all coming to play in line with what we hope to see. So that's at 49 basis points increase compared to where we were at the 180 basis points increase. It is progress. It may not be in the way we're expecting to see, but remember, this is just the first half of the year. By the second half of the year, we begin to see the expected changes we hope to see in the inflation numbers.
All right, thank you so much for your time on here today. My namesake there, Kenneth Onuoha, team member at Assets and Liabilities at UBA.